So this has been a tough week for markets, with the 8th consecutive day of down markets in the S&P, which is the first time this has happened since 2008. This is reflecting the election result that we'll have next Tuesday in the US, and we've also had significant political volatility and therefore currency volatility in the UK this week. So looking at that first, yesterday we saw a very big move in sterling against the dollar, up 1.2% during the day. That came in two legs. The first leg was a High Court ruling that Article 50 to be invoked would need to go through Parliament. That raises questions about the timetable and also raises questions about how aggressively the UK government can pursue their negotiations. Slightly later in the day, we had the Bank of England inflation report. Again, we've got good data coming from the Bank of England, and also a movement off that implied easing bias that the bank had towards a more balanced view of where interest rates might go. We now see sterling in the middle of the range that we've seen since Brexit. So pre the Conservative Party conference, we had a 130 on sterling dollar at the sort of height of concerns about a hard Brexit. That fell to around 121. We're kind of in the middle of that range at the moment. The US, we really are now focusing on that countdown into Tuesday, and markets have got increasingly nervous since last week as Clinton's lead has narrowed from around 90-10 to around 60-40 in the polls. As a result, we've seen the VIX break through its 20% level. We've seen gold go higher. We've seen the Swiss franc go higher. And we've seen investors positioning for a steeper yield curve. This is a reflection of what the market feels are the implied policies of a Trump win, which would be more aggressive tax cuts and potentially more aggressive infrastructure spend. Potentially we also might see a weaker dollar on international concerns, which would lead to more input inflation coming into the system and therefore ultimately higher rates. At the same time, we continued to see these market concerns about the technical policy deficiencies that they see and the movement that we're seeing in front of us in terms of going away from negative interest rates on monetary policy towards a fiscal policy solution. And that bottoming out of the capital cycle is starting to change the relationship between inflation and how the market reacts. So up till around June of this year, we saw increased inflation being met with higher markets because it was felt that we were going from a deflationary environment to a more inflationary, more corporate-friendly environment. Now markets have got to sort of inflection in terms of being more concerned about where inflation might go and the impact on how high bond yields can go in response to that. And that's quite an important change for investors and positioning. At the same time, we've seen, despite all this volatility and nervousness, a general rebound in economic numbers. And particularly in Europe, we're now at an 18-month high in terms of the economic surprise index. And that we're seeing echoed in the global economic surprise index. So drawing all of this together, we feel that higher yields, a little bit of inflation are good for equities. We expect significantly more dispersion in terms of stock performance than we've seen during this phase where quantitative easing has lifted the PE on all of the market, and then the falling of bond yields has increased the relative attractiveness of equities against the bond market. So we really do feel that the underlying returns will be far more important. And here we go back to, if we look at the S&P, around 20% of companies in the S&P have a 5-year falling compound annual growth rate, which is far higher than we were in the 1980s when it was about a quarter of that number. So it underlines the importance of being on the right side of what we see as significant fundamental disruption across many, many industries in markets at the moment, which perhaps hasn't played out into stock prices quite so much because of that monetary policy. So we would use the nervousness that we're seeing over the direction of policy and over political risk that we're seeing in markets as an opportunity to pick up high quality stocks on the right side of disruption. Looking at, for example, Nike and Disney, since the start of the year, we've seen quite a material derating in both those stocks, and we feel actually the prospects for both businesses remain as strong as ever. Looking at next week, Disney are reporting, so we'll see them reporting on Thursday. On Monday, we've got HSBC and Ferrari. On Tuesday, Marks & Spencer's, Direct Line, TripAdvisor. Wednesday, East Shore Solar City, Heidelberg Cement. Thursday, AstraZeneca, National Grid, Michael Kors, Continental, Deutsche Telekom, and that's about it for us. So that's it from me. Thanks very much.